Hi everyone, Mark Hestro here with Bridgeport Asset Management. Thanks for taking the time to join us today. I'm joined by Ian Hardacre, our Head of Public Equities at Bridgeport, Boyan Lepoev, Vice President, and John Fisher, President of Bridgeport. Today we're going to take a few minutes and we're going to do a 2024 market recap. We're going to take away what we learned from that and we're going to do a 2025 outlook. What was one of the biggest takeaways we had in 2024, John, from a client perspective?
Overall, obviously, 2024 was a great year for most asset categories. That includes equities, bonds, as well as most of the private asset categories. Equities really were the real standout, and specifically U.S. equities, had their second great year in a row after 2023. But I think it's still somewhat of a bifurcated market in the U.S. stock market. You've got a handful of tech-oriented stocks mostly that are powering the market ahead. If we look at, say, the S&P 500, you've got about 10 stocks there that actually represent 40% of the S&P 500 index, and they actually powered last year about 2/3 of the total return on the S&P 500. So it's really a handful of stocks. They tend to be more highly valued stocks, so more expensively valued stocks relative to underlying earnings. Some, of course, more expensively valued relative to others. But overall, it was a great year. S&P 500 was up over 20%. Canadian market was also up slightly less, but also did well. Bonds perform well in most markets as a result of declining interest rates and sort of slightly lower bond yields. And private asset categories did well, I'd say, with the exception of one or two areas.
We get a lot of client questions on shifting between Canadian and US or even among the different asset classes. So I know John just talked about the overall markets in 2024. Ian, maybe you can provide just a little bit more insight into that and any sort of opinions on whether shifting makes sense.
Yeah, sure, Mark. So if we look back at just talking about public equity markets, as John pointed out, very strong year both in Canada, really globally, Canada, US, and global markets. US was driven really by technology. Financials were very strong. Canada was strong across the board with the exception of communications and media. Public equity markets in 24 globally were driven by monetary policy, so decline in interest rates. In Canada, we saw five declines in interest rates starting in June of last year. In the US, we saw 3 starting in September. So declining interest rates are clearly good for equity markets. Other issues that we think about for 2024 was really focus on AI, artificial intelligence, how that plays out both when it comes to productivity of workforce, but also just individual stocks as well. Geopolitical events were a big issue. And something people don't really talk about is just government debt levels as well, like very high. It's one of those things that's sort of in the background right now, but we could see as we go into 2025. When it comes to mixing asset mix, obviously it comes down to the individual. Historically, global markets have done better than Canada because in Canada we have a very small market that's driven by financials and energy make up close to 50% of our market. And we have very good financials and we have very good energy companies, but the global picture, there's just more companies to pick from on the public equity side.
Right. Okay. Thanks, Ian. I think it's inevitable that anybody who follows the market, who has any degree of interest, you're bombarded with what's happening in stock markets on a daily basis, whether it's the S&P, the TSX. It is by far the most in-your-face data. However, here at Bridgeport, we do have a great deal of focus on private assets. And maybe, Boyan, you can tell us a little bit more about that, how that did in 2024 and how we're looking in 2025.
Happy to, Mark. So private markets, the way we think about them is in 3 buckets, sort of credit focus or income focused strategies, private equity and real estate with infrastructure as well. So on the credit and income strategies, I think 2024 was a very good year for those funds, those managers who focus on special situations they were able to buy or provide sort of structured credit to situations where there was a lot of value to be extracted. They could be very opportunistic. We also saw strong leasing strategies. Lease rates increased with interest rates. They always have a lag, so they saw the full increases in 2024 finally. And lending in general was very strong. Private corporate lending and any sort of even mezz lending, they did not, any of these managers did not experience much credit issues. And that sort of boosted returns while they were able to charge higher rates, and they were finally being paid more for the risk that they take. On the private equity side, I think it was an okay year, a bit of a quiet year. Private managers were somewhat cautious, somewhat conservative in marking the level of their holdings, primarily because lack of sale transactions. They did not manage to sell businesses. They did not want to sell businesses. There wasn't a lot of buyers in the marketplace last year because of high cost of borrowing. And as you know, private equity is driven by cost of borrowing. Finally, real estate is a challenged area. It is a volatile space because of benchmark rates being much higher than what they used to be 2 years ago. We saw a lot of managers lose money. It was not uncommon to see sort of like 10% declines. None of ours sort of had that. By function of our cautious approach investing in that space since we launched our fund in 2022, and also because of sort of the commitments that we've made are to be drawn over years in the future. So we had the benefit of not experiencing any of this. We had somewhat of even slightly positive return last year, but this is a challenging space, and it's incredible. It's incredibly. A manager could be very opportunistic in this space, and so we're very happy to allocate new money and sort of reap the rewards. As fundamentally, I think there's very good sort of backdrop.
That's great. Yeah, you touched on a very interesting point early on. You said something about special situations, and these are effectively managers who focus on volatile markets. And perhaps, John, you can add a little to that, especially with all the uncertainty we're seeing in the last month and even just today.
Sure. Yeah, I mean, one of the things that most private asset managers are able to really take advantage of, given the structure of their funds, where they've really got kind of committed investor capital from folks like us and other institutional investors, is they're able to take a very long-term sort of view on investing in areas. So anytime where there's a period of distress, such as early in the pandemic back in 2020, and they're able to pick up or invest in high quality assets at cheaper prices because other sort of market participants don't have liquidity to invest, or a company may have problems that it needs to fix that are short term, you'll often see these private asset managers be very aggressive, taking advantage of market distress, volatility, a lack of liquidity from other participants in the marketplace, and they'll buy up assets on the cheap with a long-term view. And we saw a lot of that in the latter half of 2020 with various managers that focus in on these areas where some of the returns that they've subsequently earned from making those investments 4 or 5 years ago have really been phenomenal, because they were able to buy these assets at prices that would not have otherwise been available at that price if not for COVID and all the issues that it caused. So it's one of the nice things about private assets. It's not dissimilar in sort of public equities. I'll let Ian speak a bit about that, but sometimes volatility can sort of be your friend.
Volatility can be your friend. So we can talk a bit about more of that with public equities.
Yeah, absolutely. I think as you look at public equities, obviously they're generally more volatile than private assets. As we went into the beginning of January this year, I mean, if we had one theme, it was bracing for volatility. When you look at the volatility factors, first was, the change in government in the U.S., and we could go into that in detail, but if you'd asked us at the beginning of January, I would say that's going to play a factor, and I think it's played a factor, more of a factor than almost anybody thought. So with the new president coming in and putting in tariffs, et cetera, and how you handicap those, it just happens that they, were put in today, the day we're shooting this, right? So, how you handicap that, things could be different by the end of the week, right? But I think when it comes to tariffs, if they're in for a long time on Canada, when I say a long time, and probably a year plus, that's going to be very, very bad for our economy. If it's a negotiating factor, which we'll find out, that's a little bit different. So that's a large factor. The other thing with public equities this year that could brace for volatility is multiples are high. The S&P 500 is trading at about 22 times earnings. If we don't get earnings growth, then it's hard to see how that market and global markets are going to work unless we have earnings growth. And tariffs are going to hit earnings growth. We have geopolitical events as well. They're definitely a factor. And then, as I mentioned earlier, high debt levels are going to be a factor at some point. So, for our funds, it comes down to our 20 stocks in each fund. So it's really stock by stock. It's not just the market. So we're very selective. But when it comes to volatility, it provides opportunity for us because our investment philosophy is really about doing your homework on a name, figuring out the buy price that you want to buy it at, and just wait and be patient and take a longer term view. And so the volatility creates that opportunity for us. That's generally, historically been good for the investment style because it allows stocks to get displaced and us to allocate capital and invest in companies that are high quality companies but inexpensive.
Oh, that's great. I appreciate that. So for those that need to hear us beat the drum again, perhaps we can talk about our advice for proper portfolio construction, especially in these times of uncertainty.
Sure. Yeah, I can start off there. I mean, obviously, we take really a balanced approach, given the mix of publicly traded assets and also private assets that we have available. It's really a pension fund, institutional style asset mix where we're trying to do our best to maximize the overall portfolio rate of return while minimizing portfolio kind of volatility. So from that perspective, I think it really makes sense to have a well-balanced portfolio, especially in light of all the things going on. It's very hard to predict, as Ian said. Tariffs are going to impact many different industries, but you do want to make sure that you're not overly concentrated in any one industry. President Trump could come out tomorrow and change his tactic. Instead of being across the board broad tariffs, he may start to target individual industries. Canada may put in counter, export tariffs also on certain industries. So a balanced approach, I think, is key because I think anyone that says they can completely predict where any of this is going, I think that's very unlikely. And so, it's important that I think you have both businesses that are selling products and service globally, as well as businesses that are selling more on the domestic front, both in the U.S. and Canada, as well as abroad. I think you got to have that kind of mix, and I think we feel pretty good about it. And we're making adjustments as we see changes and what's going out there. But I think it's always important too. I'll just finally say you don't want to be overly reactive in these situations. Like we've seen this type of situation now many times, and there is I think a feeling among a lot of people I need to be doing something, making radical changes. And often, while at the time that may feel like the right thing, after the fact it usually is proven to be the wrong thing. You can make some modest adjustments, but radical adjustments that are reactive usually end up costing clients portfolio return over the long term.
Yeah, unfortunately, we've seen that quite a bit.
Yeah.
Okay, so maybe just taking a little bit of a change here. There's always the perpetual question about interest rates. Every year it comes up. So, Boyan, maybe I'll let you to go with it first. Thoughts, feelings on what do you think will happen in 2025 with rates?
As Ian and John both said, it is very hard to sort of handicap what President Trump will do, what other countries will do in response to him, and overall sort of how the global economy will behave. But What we do know is that, let's say, threats of tariffs, not necessarily just the tariffs themselves, but they tend to be inflationary. Curbs on immigration, again, inflationary. So it is right now, the way the cards are stacked, the way economists expect rates would be, is that they will remain higher for longer. And with this in mind, we try to invest a bit more cautiously and spread out our risks. What do you think, Ian?
Yeah, I mean, I think at most, in the U.S. and Canada, they probably have a little bit room to go down over the year. I'm not sure when that it is. As you say, the Canadian economy is a lot weaker than the U.S. economy. So I think Canada's already moved down 25 basis points. Seems like there's more room to Canada move than the U.S. And that's going to affect the dollar as well, right? Like the Canadian dollar's weak and may stay weaker. Dollar currencies are hard to predict, but I think there's a little room in both countries to move rates lower.
I agree. I think it's going to be a little bit of a tale of two sort of countries. I think you'll potentially see, greater lower rates, sort of an oxymoron, but sort of more kind of lower rates in Canada. The U.S., given what they're doing, may be challenged to drop rates very much because I think they've already got a stronger economy. They've already before immigration curbs and before the implementation of these tariffs, they've already got stronger inflation. They have to be a lot more careful with it. And I think if you overlay protectionist strategy, immigration curbs, they may not see a lot of rate cuts, whereas Canada, I think the economy isn't as strong and the central bank may want to, stimulate economic growth more by dropping rates. But, as Boyan said, it's never a certainty. It's always nice to make a prediction. I guess that would be mine.
Yeah, no, I'd agree with that. I mean, when you look at the Canadian economy too, just to add, unemployment's at a 7-year high, and GDP per capita is quite weak, right? So there's probably room, John pointed out, to move rates a bit lower versus the U.S.
Yeah. Well, thank you for that. Yeah, that's great. Let's dabble, if we can, into the geopolitical situation here in Canada. Let's not wade too far out of our side of expertise, but the Canadian Parliament is prorogued as we speak, suspended. How does this play out politically for Canada?
Who wants to take that one? Ian, you want to go first?
Yeah, sure.
Older PNs, please.
It's the timing of this is horrible. We don't have any leadership really because the Parliament's closed and we're going to election both in Ontario and federally, presumably at some point in the next little while. So that you could align the fact that the tariffs and the pressure on Canada has something to do with that. We need to get our house in order for sure. And we need to fix the economy and we need to have a government that's more pro-business, whoever that would be. So that would be my 2 cents on that. But I think you can have consensus that we should have people in Parliament doing what they're paid to do.
We won't spend too much time talking about the capital gains tax.
Yeah.
John and I had actually put together a little video, and lo and behold, it was canceled this weekend. So just this last week. So there goes our video on that.
Yeah.
But,
exactly.
anyway, it's probably everybody can agree that it was the right thing to do for now until there's just more certainty with our political situation and everything. So maybe we can shift the mood a little bit to something a little more lighthearted. We're coming into Super Bowl weekend. I don't think anybody at the table can profess to be odds makers, but Ian, let's hear it. How are we feeling?
I got to go with KC.
KC?
Yeah, KC. I'm going for the favorite.
All right. Fine.
I don't know the name of this team since I don't watch this sport, but this is it. This is the logo, and I love this logo versus
But
the
if
other.
we're doing soccer, you'd have an
Yeah.
Yeah.
Boyan watches football. It's just the other football.
Yes,
right?
the real
So,
football.
I got to go KC. I think KC's going to win. I think they're favored. I don't know if anyone knows what the odds is, but it's a coin toss. I'm going with KC. I think we did this last year, and we had 3 out of 4 people were right. They chose KC. But Mark, who's
Well,
your choice?
It's being a coin toss. I will make a pretty bold prediction that I will have the best Super Bowl chili in the GTA, no matter what the outcome. So with that, thank you all for taking the time to watch. Anybody, please, any questions whatsoever, please feel free to reach out to Bridgeport. Thank you for your time.